If you watched the market this past Friday, you saw the seemingly unstoppable U.S. stock market suddenly pull a violent U-turn, leaving all three major indexes bleeding heavily. While retail investors are probably still hunting for news headlines, the institutional heavyweights on Wall Street already started dumping shares and running for the exits at 8:30 Friday morning. Today, we are skipping the useless technical chart indicators to dissect the three core powder kegs behind Friday's market plunge. To understand Friday's drop, you first have to understand the non-farm payrolls report released right before the opening bell. To put it bluntly, this report is the health checkup for the U.S. economy and the master switch for global capital flows. On paper, the numbers looked incredibly beautiful, job growth crushed expectations, looking so good it felt like a direct taunt to the bears. But the old foxes on Wall Street took exactly 1 second to rip the mask off this report. They realized that these so-called new jobs weren't high-paying tech or manufacturing roles, they were a hollow bubble propped up entirely by part-timers, gig workers, and service staff. Even more bizarrely, while part-time gigs surged, the overall unemployment rate climbed relentlessly. In insider circles, this is called a structural collapse. It means the true middle-class core is getting hammered by layoffs, and people are forced to juggle 2 or 3 part-time gigs just to scrape by. The grand illusion of prosperity was suddenly and violently pierced by cold, hard data. Once the multi-billion-dollar whales realized the U.S. economy was actually bleeding from the inside, their confidence evaporated, leaving them with only one move: liquidate and cash out overnight. The second domino to fall is the toxic pill the Federal Reserve officials are forcing down the market's throat. Wall Street had been aggressively betting on aggressive rate cuts in the second half of the year, hoping cheap money would flood back into the market to pump up sky-high tech valuations. But Friday's superficially red-hot job numbers gave the Fed the ultimate excuse: look, the labor market isn't dead yet, and inflation could snap back at any moment, so we can't cut rates. With rate cut expectations kicked down the road indefinitely, high borrowing costs will continue to act like a noose, suffocating corporate profit margins. Deprived of cheap money, the Silicon Valley AI darlings sitting on multi-billion-dollar valuations suddenly look like castles built on sand. As a result, the tech sector became ground zero on Friday, with capital trampling over itself to flee at any cost. But the most hidden, fundamental reason is that global power players are executing a silent, coordinated U-turn with their capital. As we discussed in previous episodes, whether it is foreign creditors dumping U.S. treasuries or mystery entities draining physical gold from London vaults, the smartest money is cutting ties with paper credit. Friday's stock market plunge is simply the latest reflection of this underlying current hitting equities. The big whales would rather pull their cash out to grab cold, hard physical gold, silver, and commodities than stay in U.S. stocks to catch the paper scraps Wall Street is distributing at the top. The underlying logic of finance never changes. When the wealthiest insiders start dumping assets for cash, the real alarm bells are ringing. Some think this is just a routine weekend profit-taking session, and that the market will bounce right back on Monday morning. But veteran traders who have survived actual market tsunamis are quietly whispering a warning: when the veil of prosperity is ripped away, every temporary bounce is just building energy for a much bigger crash. What do you think? Will Friday's sudden turn of face mark the beginning of the end for this year's bull market? Have you noticed the economic temperature shifting in your own job or finances lately? Drop your instincts in the comments section below.